Good day, and welcome to the DoubleLine Total Return Webcast. Today's conference is being recorded. At this time, I would like to turn the conference over to Ron Riddell, President of DoubleLine. Please go ahead, sir.
Well, thank you, and good afternoon, and welcome to the DoubleLine Total Return Webcast with Jeffrey Gundlach and Andrew Sue, titled Norms. I briefly want to highlight some of the recent content on our YouTube channel. You can check out our YouTube channel at /DoubleLine, or actually /DoubleLine Capital. But recently on channel 11, we had a special appearance by our very own Mr. Jeffrey Gundlach, titled The Federal Deficit Dilemma. And then Ryan Kimmel, we had a video. He's an analyst on our DoubleLine macro asset allocation team, where he conducts a thought experiment on different interest rate scenarios with our federal debt. Please go to our website, doubleline.com, where you can check out the 2024 webcast schedule. Also, to the upcoming webcasts, please mark your calendar for the very, very popular January 9th webcast titled Just Markets with Jeffrey Gundlach. And then we're back out on January 11th with our Roundtable Prime with very special guests, which we'll announce later. If you'd like to receive a copy of today's presentation slides, you can go to the Request Webcast Content tab, and you can follow us on our X channel at D-Line Funds and our YouTube channel, as I mentioned. Also want to highlight some thought leadership. We have two podcasts, the Sherman Show podcast and the Minutes podcast. Both of those are available on X. In fact, the Minutes podcast with Sam Lau and Jeff Mayberry is live on X Spaces every Friday at 1 p.m. You can go to X to view both the Sherman Show podcast and Minute podcast, as well as doubleline.com and other venues. DoubleLine's Channel 11 is also on X and YouTube, and doubleline.com with our portfolio manager, Ken Shinoda. And then we have the Perspectives, which are product specialists, explore DoubleLine's latest thoughts on financial markets, and that's available on YouTube as well. Some upcoming thought leadership that's coming soon. We have a new newsletter out titled Between the Lines, hosted by our portfolio manager, Sam Garza, and our analyst, Ryan Kimmel. Here, we'll explore investment trends and analyze the current financial markets as we approach the end of 2023 and into 2024. If you haven't gone to our LinkedIn sites, please go to linkedin.com/company/DoubleLine #capital to sign up and follow. We have a lot of good content coming out on LinkedIn. If you were able to view our 23 for 2023, it was a very popular series by Sam Garza, analyst He, and Ryan Kimmel. We're going to reprise that, and it will be 24 for 2024. It's a presentation where we select their most compelling 24 slides summarizing 2023 and looking at the prospects of 2024. And lastly, we have a credit opportunities panel, credit opportunities for 2024. It's hosted by our product specialist, Phil Goya, who interviews three of our portfolio managers, Robert Cohen, Ken Shinoda, and Morris Chen. Today, we'll be highlighting the DoubleLine Total Return Bond Fund. And so we have three share classes, a retail share class, an institutional share class, and a retirement share class. Here you can see the different expense ratio and minimums. And standardized performance on the DoubleLine Total Return Bond Fund launched April 6th of 2010 through 11/30 of 2023, an annualized return of 3.53% versus the Bloomberg U.S. Ag Bond Index at 2.14%. And a very, very attractive yield on the iShare at SEC 30-day yield at 5.79%. So with that, I will turn the webcast over to Mr. Jeffrey Gundlach.
Thank you, Ron, and thanks everybody for joining us here on the last webcast, at least that I'm involved in, for 2023. As Ron pointed out, we're going to be doing Just Markets on January 9th, I think it is, and that is going to talk a lot about broad markets, stocks, U.S., global, various valuations of fixed income sectors, but I'm not really going to spend much time on that today because Just Markets is just about a month away. I'm really going to focus on a topic that's become omnipresent, it seems, and growingly getting attention belatedly, in my opinion, and that is where we are in this debt cycle. I'm going to talk about the deficit, of course. I'm going to talk about inflation. I'm going to talk about the probabilities of recession, and I'm going to talk about the mortgage-related markets and commercial mortgage-backed securities markets as well. So let's get started. I started my last webcast with this slide, and it's absolutely critical. You'll notice that the federal budget deficit is very high at over 6% of GDP, in spite of the fact that we had one of the stronger quarters of GDP growth in the third quarter of this year. You'll notice that there is a trend here as well, going back to Ronald Reagan in 1980, or even Jimmy Carter in 1976, that it seems like when the red shaded areas come upon us, we get ever bigger budget deficits, particularly since 2000, where we saw it seems to be going up, almost doubling every time we go into recession. It was nearly 5% of GDP in the early 00s. It was 10% of GDP in 2009, 2010, and then it was nearly 20% of GDP during the lockdown. Of course, that's an unusual period, which may have exacerbated, or certainly did exacerbate, the deficit. But let's look at this slide in a different way. Let's look at it inverted. So now we have the red shaded area is the budget deficit. And when it goes up, that means the deficit is going up. And I've got the dotted line on here, which is the official U3 U.S. unemployment rate. That's the dotted line. And just let's consider 1970 to 2015 or so. You'll notice that the dotted line, the unemployment rate, goes up, and the deficit goes up at the same time. That sort of makes sense. The unemployment rate goes up during recession. There's more unemployment benefits. There's less tax revenue. And so the deficit tracks that dotted line very, very well for the first 35 years of this exhibit, or even 45 years of this exhibit. But then you'll notice starting in around 2015, something happened. And that is, even though the unemployment rate was going down and staying low, the deficit was going up. And that is certainly the case now. Unemployment has perhaps bottomed out. It certainly has gone up a little bit in recent months, but we see the deficit is very, very high, and we're not even in a recession yet. So what happens if this unemployment rate goes up to 5% or something? Won't the deficit very likely expand substantially? And I think the answer is certainly yes. Here's the federal interest expense on the debt as a percentage of tax revenue at the federal level. And it's going vertical thanks to the size of the deficit, and also, of course, the rising interest rates that have gone up about 400 basis points on the 10-year Treasury yield from where it had settled in at around 1% up to 5%. And of course, the Fed funds rate has been raised to 5 3/8% over a fairly compressed time period. You'll notice that the federal interest expense as a percent of revenue was higher back in the 80s. That's because interest rates were a lot higher in that period. And also we had tax cuts that happened in that period. Here is the projection by the CBO of where interest expense will go as a percentage of federal tax revenue. So it's obviously going vertical, having risen very sharply from 8% of tax receipts to 15% or 16% of tax receipts presently. And the CBO projects that it's going to go to over 20% of tax receipts by the next 10 years. However, this is very optimistic because the CBO uses interest rate assumptions that are lower than today's existing interest rates. And they also assume a lower budget deficit as a percent of GDP than is presently in place, even though we're not even in a recession yet. And so we see that they also anticipate no recession ever in their projections. So this 10-year period assumes that there will be no recession, which is very, very unlikely. So the average interest rate is rising. We know that. You can see that the average Treasury interest rate on the interest-bearing debt was 1.4% a year and a half ago, and now it's at 3.1%. Of course, interest rates are higher than 3.1% for new issued bonds across the yield curve at the present moment. So this average interest rate is going to keep going up. And the CBO doesn't even assume that. So here is the average interest rate on Treasury debt outstanding. There's the shaded area there is 3.1%. But the 10-year Treasury, as of this printing, which was just yesterday, I think, or 2 days ago, was at 4.26%. Now it's at 4.18 or 4.17 on the 10-year Treasury. When I was on for Fed Day with Scott Wapner back in early November, I talked about how I thought there was going to be a Treasury rally that had just gotten underway, and Treasuries have rallied by over 80 basis points on the 10-year Treasury. We had one of the best months ever for the long bond in November with its long duration and those rates falling. But obviously, if rates settle in at this level, and if the Fed is higher for longer, as they have repeatedly averred, well, then I think that we're going to see this go higher, and it's going to put further pressure on the deficit. Now, as I said, the CBO assumes that there will never be a recession. But what happens during recessions? On average, going back to 1969, the budget deficit expanded by 5.2 percentage points as a percentage of GDP. So we would be going on that average when we go into a recession. If we start at the base case where we are right now, we would have the GDP, the deficit percent of GDP go up to 11.2%. But notice the last three recessions over the past 20 years or so, the deficit has expanded on average by 9.4. And you could say that that's bloated by the lockdown, but you'll notice that the 07 recession, the global financial crisis, it was around that number anyway. So about a 9% increase in the deficit as a percent of GDP in recession. So what does that mean? Well, if we start with where we are today and then tack on the 5.2%, we'll see here with that adjustment that we'd be going up to about a $3.5 trillion budget deficit by 5 years from now, or even 4 years from now, as we're turning the calendar year shortly. What if it goes up by 9.4% of GDP, the average of the last three recessions? Well, then the budget deficit would be $5 trillion, which, based upon today's GDP, would be about 20% of GDP. So this is something that's coming barreling right at us, and I see newspaper articles and newswire articles all the time now on people talking about how this, what used to be something that we could worry about 50 years from now, is now more like 50 months from now is where these problems are coming. So let's talk about this. Now, is a recession coming? I guess that's the question that's begged by the preceding two exhibits. Well, we have been checking in on some of these indicators for all year during 2023, and they're getting to be much more recessionary looking. Here we have the 2s, 10s yield curve, and I've pointed out in the past that it inverts usually a year to even 2 years before the onset of the recession, the red shaded bars again. And then it de-inverts, and it's when it de-inverts. Notice those red arrows. It's showing the de-inversion of the yield curve, and really it tends to be the front edge of a recession right about when the curve is now de-inverted from 2s to 10s. We got to 108 basis points of inversion, then we got down to almost no inversion for a brief moment, and now we're around 40 basis points of inversion. So if the Fed indeed does not cut interest rates, and should the 10-year continue to rally, well, we might invert sometime in the next couple of quarters. This is obviously a very leading indicator. Gets a lot of attention on financial media when the curve first inverts. There's almost a crawler on the screen on financial programs where they show that the curve's inverted or de-inverted, but that's not really the issue. It has to stay inverted for a while based upon history, and then it de-inverts, which is happening. So this is completely consistent with the potential for recession, say in the second quarter or so of next year. Here's the Philadelphia Fed Coincident Index, and this is just the number of states that have a negative monthly change in their Philly Fed Coincident Index. And I always like to point out that it's when conditions really start deteriorating in real time that you have to be on strong recession, very alert for recession watch. Well, we now have 32 out of 50. Maybe there's Puerto Rico in here, or maybe it has DC, so it gets 51. I'm not sure. But we're at 32, and if you go back to 1980, you'll see that you don't really get this high without a recession coming or even being in recession. So this is looking like a recession signal. And then we have the unemployment rate, which is the last indicator to trip. It's not a leading indicator. It's at best a coincident indicator. And we always show the unemployment rate, which is that black line, and the dotted line, the red line, is the 12-month moving average of the unemployment rate. And you'll notice that when it crosses over and starts to gently rise, that tends to be the onset of a recession or near the onset of a recession. And once it starts to rise by anything much more than a half a percentage point and goes through its moving average, you'll notice that the unemployment rate going back in the last three recessions has accelerated very dramatically. So it's kind of like from the sun also rises, how did you go bankrupt? He says, well, two ways: first gradually, and then all at once. And that's kind of how the economy works as well. And then we have the one that never fails, and that's the unemployment rate versus its 3-year moving average. the 36-month moving average, and that has not tripped yet. But unless the unemployment rate starts to go down, which doesn't look like it's happening here, you're going to have this crossover somewhere in the first quarter or early in the second quarter of 2024, which is why I think strongly there's a probability of recession coming. And this is why this deficit problem is going to not just be in newspapers virtually every day as it is now, but it's going to be a nonstop topic. I noticed that there are now 36 Congress people that are not running for re-election. Maybe may turn into 37 today. I think one of the reasons that they want to leave is they can't get anything done on these fundamental problems and issues. So this doesn't have much to do with what I'm talking about, but I thought this was really interesting. It came up in our macro meeting last week. And what we have here is surveys: Consumer Price Index of Housing Survey, Unemployment Cost Index, which is a survey, Current Employment Statistics, which are surveys, the household survey, and then job openings and labor turnover. And something odd has happened. You'll notice that not very many years ago, the responses to these establishment surveys were around 2/3 or even 70%. Something weird has happened, particularly on the job openings. You notice how there's only 31% or so of surveys responses being collected. It makes you wonder if these surveys, which I don't really ever like surveys, I don't rely on them very much at all, but at least back in 2015, you could have thought, well, you're getting a pretty broad set of opinions here, so you're getting a good read of the overall situation. But if you only have 31% of people responding, it strikes me that these surveys are tremendously unreliable. You might, if you want to be a conspiracy theorist, you might even think that they're being manipulated. Maybe they're throwing out 40% of the responses because they don't like those responses. I'm not so cynical as to believe that, really. I'm being largely facetious. But the point is very, very interesting here, how people are just disengaged. All right, so let's take a look at how things might stand now versus the history of going into recessions. Let's look at the backup in the unemployment rate. So what we've got here is the shaded blue area. That's the two middle quartiles of recession experiences. So we got the 50% in the middle, and then we see the black line is the median, and then we have the current, which is the red line. And I'll be darned if the current doesn't look remarkably like the front edge of a recession based upon where the median is. And again, once this really crosses over the zero, it tends to accelerate. Based upon the best fit here, we could actually be in recession right now. Here's the 2-year Treasury yield around the Fed's last rate hike. Just another way of thinking about things. This is the two middle quartiles of Fed hiking experiences. And you'll notice that the median, that dark line, is exactly perfect in predicting the last rate hike. The change in the 2-year yield, it peaks out right at the Fed's last rate hike. Well, that happened. That's already happened. Obviously, yields have dropped a lot since the Fed last hiked rates, and that would be consistent with the peak in rates being in. Here's the 10-year yield around the Fed's last rate hike, and it's not as dramatic as the 2-year, but it is also perfect at predicting the Fed's last rate hike on a median basis. So it's interesting. So perhaps the peak of yields is in. I would point out that we have a trend line that goes back 2 years on the 10-year Treasury yield, and we're sitting right on that trend line, having gone from 5% down to about 4.18 or so. We're sitting right on that trend line. If we break that trend line, the next one that kicks in is down at around 275. And now I'm going to put in one more slide. This is the shape, the slope of the yield curve, 2s, 10s. It's not exactly perfect on the median, but it is exactly perfect on the averages. So at this point, you might be wondering why this presentation is called Norms. And on the title page, I showed one of the 23 existing Norms restaurants, which were founded around 1949 or so. And the one that I used to go to one down in Santa Monica, and I went there. Nobody knew who I was. I'd sit there at the counter. It's like a diner, and I would get a Denver omelet. And the funny thing about the Norms sign is it says on it, "We never close." And indeed, the Norms that I went to did close in 2013. What they meant by "we never close" is they were open 24/7, but finally it got sold and that Norms closed. So why am I talking about Norms Restaurant? Well, Norms is a name, first name, but also norms are the societal norms, the standards, the institutions. And the institutions, when you're a kid, you think that the institutions are forever, and that's in a sense that the norms of society never close, that they stay open, they stay fixed, and they never change. And I've been talking about the fact that was not going to be the case when we got into the latter part of the 2020s, because the institutions are falling tremendously out of favor. There was a Gallup poll done recently that looked at 16 institutions like the police, the military, the Supreme Court, the presidency, things like that. And what is your faith in these institutions? And the majority of them, the great majority, are plumbing all-time lows. The Supreme Court is at an all-time low. The presidency is at an all-time low. Congress is 1 point above its all-time low. And so these norms are being rejected. And one of the norms that we've been living on is debt, an economic scheme that's based upon debt. And now people are realizing that can't continue. We obviously have a lot of challenges with public education being a controversial place, charter schools being controversial, laws being changed. There's a Supreme Court case being adjudicated about the tax collections on unrealized taxes are they constitutional or not? All of these things are up for grabs, and this is all going to change. And with it, this debt-based scheme will change, and the way in which that we are operating and not paying for things is going to change. And while it's going to be an interesting time period to get through it all, I'm very excited, because on the other side, we're going to have that first turning where everything falls into place again. But now we have this next 5 years before, maybe 5 to 7 years before we get to that better place, level ground to stand on. So that's what we're talking about, norms. Now, this is something that people have been talking about, particularly since the regional bank problem back in March. There have been a flood into money market assets. They've also been a flood into those assets because the yields are high. The highest yield on the Treasury yield curve has been the 6-month bill for a while now. A lot of people look at this and they say, wow, this is really bullish for financial assets, risk assets, even stocks, because look at all this money on the sideline that can come piling into the market. I think there's some truth to that, but I think it really misses the point. I think people are going to go from a money market fund at 6-month T-bill and chill type of a situation and go into the ARC type of fund or the Magnificent Seven type of fund. That's such a monumental change in risk appetite that I don't think it's logical. I actually think that this spike in money market fund assets is bullish for bonds, for Treasury bonds and other high quality bonds, because it's much more likely that you would go from a money market fund into, say, a 5-year type maturity Treasury bond fund than it would that you go into some massively high PE, crazy volatility type of risk asset. So I think this is very bullish for bonds. And we saw bond yields rise back from September in particular into late October. There was a big rate rise. That had a lot to do with, I think, lack of demand for bonds, but that seems to be changing, and I think it's going to change going into 2024. Here's the we'll talk about the state of the mortgage market. One of the things that happened with these rate rises for the past couple of years is a lot of people thought that housing would be very significantly challenged because of the mortgage rate going up by such a large amount. But the opposite really happened. It curtailed supply so much on the selling side that home prices have actually, on a national average basis, gone to a new high, even above the peak of 2022, which people mostly thought was the peak, but that's been eclipsed. I think we might see the opposite going forward. If mortgage rates go down into, 5.5%, 5.25% zone, it might unlock supply. And so ironically, we might have housing prices deteriorate along with falling mortgage interest rates, the opposite of what most of our 40-year experiences have been. This is the theme that I've been talking about now for about a year and a half, that during rising rate regimes, things will behave differently than you would automatically think of if you've experienced only falling rate regimes. So one thing that has also happened with mortgage rates going up, you see the red line is the average price of the U.S. mortgage-backed securities index, and it was up there at 105 or so in 2022. So there was nothing but prepayment risk, because if rates would fall, you would get your money back quickly at 100 due to refinancing. But now the mortgage market was down at about 87 cents on the dollar, which means there is no prepayment risk. In fact, defaults on mortgages help you in agency guaranteed mortgage index type of investing because you would get 100 back more quickly from today's market value of 87. So the risk in the agency mortgage market doesn't really even exist. It's simply reward that you might have something happen and start getting faster payback on mortgages all the way through the 90s and the 00s and into even the 2010s. You had to worry about getting paid off early in mortgages. Not anymore. It's actually a positive. Let's take a look at another norm that has changed. Obviously, I talked about this 40 years of falling interest rates. We have 33 of them on here. You'll notice we were well behaved within this channel. The red line is the trend line, and then we have these 1 and 2 year sort of standard deviations around it. And you'll notice we've completely broken out of that trend line. So people talk about how rates are still really low, but they're not really low. They're kind of the same as they were nearly 20 years ago. So rates have gone back to where they were 20 years ago. Let's check in on the copper-gold ratio. Ratio of the price of copper to the price of gold. It really diverged very substantially once the pandemic came. First, the copper-gold ratio was very elevated. It turned out to be accurate in predicting higher interest rates on that red line back in 2021, particularly, and into 2022. And then the price of copper versus gold dropped and now shows a divergence the other way. And sure enough, it's starting to shrink, that divergence. Finally, having been diverging all year, it's now reversing, and we start to see yields falling on the red line and starting to catch up a little bit, although there's a lot of room to go. You'll notice that if where the copper-gold ratio is right now, it predicts around that 275 type of a 10-year. That's interesting because that's where that trend line kicks in. Should we break below this 417 type of a level that we're sitting at now? However, I have been expecting, as the economy is perceived to be weakening, that we would get a Pavlovian bond rally, and we're in the midst of it, that bonds have been rallying. But I don't think it's going to last because of this debt problem. Here we have two very long-term indicators that have served us well. This is the first of the two. This is the 10-year Treasury yield compared to, that's the blue line, and the green area means that the 10-year Treasury yield is above the 7-year moving average of the core PCE. And you'll notice in the 70s and 80s, the core PCE, was really being pulled higher. The Treasury yield was being pulled higher, pushed higher, I guess I should say, by the core CPI moving average. And then when the 7-year moving average of the PCE rolled over, lo and behold, that was the peak in rates. And then it was pulling rates lower for all that way into 2016, into 2020. But now the line is going up again. And I think it's going to ultimately pull rates higher once we get through this Pavlovian decline in interest rates because of the debt problem, which we're going to get further into. Here's another 7-year moving average. Here we're just using nominal GDP. And it has very much the same look, although the interest rate was lower than nominal GDP during the 70s and 80s. The interest rate got pulled higher by nominal GDP rising monotonically. And then just like the last exhibit, it rolled over in the early 80s and then the 10-year Treasury was pulled lower. And however, this is reversed course as well back in around 2016. And now we have what might be the beginning of a more secular increase in interest rates, at least until such time as we deal with this overhanging debt problem. So let's look at inflation. Very much in the news these days is, the Fed says that they're higher for longer. They're not going to cut rates. They're going to ignore the bond market. They're going to wait for inflation to get to their target of around 2% or maybe close to that. But let's see where we are. This is the headline CPI and the core CPI. And the core CPI is the blue line, and it's at 4%. And we see the red line is at 3.2%. So we're pretty near 3% on the headline CPI. Our inflation model suggests that inflation is going to stay in the 3 handle for the few months to come, and then reside, all things being equal, which importantly includes energy prices being relatively stable for that period. We would see the CPI go down into the mid-2s. Say in the early summer or midsummer of 2024. We'll see. Let's look at some other inflation measures. Here's the core CPI, which is running at 4%, excluding the shelter component. So if you just take shelter out of the CPI, which of course is a big enough slug of the CPI that it matters, it's around 1/3 of the CPI, the inflation rate ex shelter on core. So we're ex food, energy, and shelter. So we're missing a lot of key components, but that's sort of like that super core PCE that Jay Powell used to talk about and has been mum about in the last couple of months. But U.S. core CPI ex shelter is exactly at the Fed's target of 2.0%. So if shelter would calm down, then we would be at around the 2% inflation target right now on the core basis. Now, this is the CPI owner's equivalent rent. That's the blue line. And the red line is the Zillow rent index, all homes year over year. And you'll notice that the Zillow index tends to lead by about a year. And the owner's equivalent rent is by design a lagged indicator, sort of a smoothing mechanism. So when prices are going up, the shelter component lags and artificially depresses the CPI. And then when shelter is coming down, it keeps CPI artificially high because it lags real prices. It's pretty clear here that if this relationship holds, that we're going to be seeing about a 4% decrease in the shelter component. So if we're going to get that would be 1.3% out of the CPI. And so you can start to see that we're really looking at CPI numbers. If shelter behaves itself, which there's reason to believe that it should, well, we should be not so much of an inflation problem, further supporting perhaps the strength that we've seen in bonds recently. Here's the CPI shelter component versus the Case-Shiller home price change. And similarly to the other one, although less convincingly, there's a big gap right now between the shelter, the red line, which is elevated, and the Case-Shiller, which had a big backup bounce in the last couple of readings, but it's still about 300 basis points lower. So about a third, about a 1 percentage point could come out of the CPI. Let's look at some other inflation measures. This is the core PCE and the headline PCE. I think the Fed likes this statistic better. I think it's a little bit less volatile. You see that the core PCE, the blue is at 3.5, and the PCE headline is at 3. So not very different from the CPI. Here's the one that Jay Powell introduced a little over a year ago and said it became a very important inflation measure. Well, he doesn't talk about it anymore, but it's the super core PCE. And it is finally broken out of what had been a pretty sticky range up there in the 4.5 category. It's finally down below 4%. Supercore CPI, which we talked about, is really pretty much the same right now as a supercore PCE. I'm going to flip to the right page in my deck here. Forgive me for a minute. Okay, here we go. So let's look at U.S. headline and core producer prices year over year. So one thing that's interesting is the PPI got as high on the final demand basis of nearly 12%, and then it collapsed. So it went down just as fast as it went up. And then we see the ex-food and energy, same thing, it's just not as volatile. So as we're sitting here today, as of through October, we see that the headline PPI is only 1.3%. So there's no inflation problem there. And ex-food and energy, it's at 2.4 and appears to be still trending lower. I don't really see a big inflation problem here. I don't know if it's sensible to average these two, but if you averaged them, you'd actually be below 2% on PPI. The ones I like the most, I say this every webcast, these are unadulterated prices. They're not seasonally adjusted. They don't have all these other adjustments for so-called improvements, technological improvements and stuff. So we actually have negative, and we've been negative for a while after being in the teens for both import and export prices, but now we're living at -2 on import prices and -4.9 on export prices. Obviously no inflation problem here. If you average these two together, you get about 3 3/4 type of negative inflation. No problem there. So look at the old bugaboo for the PPI back a couple of years ago. It was those supply chain bottlenecks everybody talked about. Well, there aren't any anymore. In fact, the supply chain index from the New York Fed on a global basis is at an all-time low going back to 1998 and doesn't show any pressure whatsoever. I'll point out that it has been negative much of the time prior to 2020, but now it's more negative than ever. So there is no pressure from that, no inflationary pressure. And then finally, the Bloomberg Commodity Index really can't get out of its own way. After rallying into 2022, coincident with the peak in reported inflation, the Bloomberg Commodity Index has been soft. And it tried to get above its 200-day moving average earlier this year, but it couldn't do it. That's the red dotted line. And now it seems to be accelerating to the downside. Now we're fully about 5 percentage points, or 4 percentage points anyway, below the moving average. It's one of the biggest distances we've had in the past 6 months or so. So not showing inflation there. Now we have the monthly mortgage payment on a median sales price home. And this is a function of home prices going up in the last couple of years, and of course, interest rates going up. But look at the delta here. Back about 5 years ago, the median monthly payment on median sales price home monthly was around $900, and now it's at $2,300. So incredible lack of affordability. I believe that if mortgage rates fall further by, say, a percentage point, I think we'll actually start to see home prices weaken because we'll unlock supply. Just sort of the opposite of what people's intuition has been informed of, thanks to the secular decline in interest rates now having been reversed in the past few years. U.S. housing affordability, not surprisingly, is very, very low. It's really out of the context. This is another norm that's been broken. The affordability hasn't been this bad in a long time. And then we can compare buying to renting. So 3 short years ago, it was cheaper to buy in most parts of the country, not exactly on the West Coast and not certain areas of the Rocky Mountain states. But look at it now on the right-hand exhibit. It's now cheaper to rent by a fair amount in almost all places, except for sort of the Southeast and then parts of the sort of rural Midwest. But monumental shift here, and this has a lot to do with why we have seen the housing prices remain so strong with higher interest rates. Here's the U.S. pending home sales index plumbing 22-year lows, even lower than it was in 2020 in the lockdown. So the home market has been greatly distorted by the interest rate movement and by the home price appreciation. Here's the MBA U.S. Home Purchase Index, and this we have going back 30 years, and it hasn't been this low since 1995 or so. So it's incredibly weak, and it has probably the lack of turnover in houses may have freed up money for people to buy other stuff or do other things rather than have to buy furniture for a house if they're moving out of an apartment or something like that. Here's an interesting development, and this is kind of in response to homes being so expensive. We see homes, including single family and multifamily, under construction, and the bottom area there is single family homes under construction, which is shrinking, and then we see the orange area, which is multifamily units under construction, and they've always moved together going back to 1970. Almost month by month, or certainly quarter by quarter. But look what's happening here. We have a fall off in homes under construction, and we have a still very robust multifamily under construction. That should be disinflationary for rent as these units go from under construction to available for rent. So this is not really an inflationary situation. Now let's look at some bloodless verdict of the market. This is credit performance year to date through December 4th. And this is just a credible dispersion from the strongest sector, which is double B CLOs, below investment grade CLOs, and then triple B CLOs. And then we've got junk bonds, the junkiest of the junk bonds, triple C loans and triple C high yield, and then even single B loans and the leveraged loan index broadly, and high yield single Bs, all up double digits, 10% to 21%. And then you get into the middle part of the capital structure, and in a corporate area, you're up about 6 to 9%. And then you get over to the side to higher grade securities, and you're down 6.4% on CMBS triple Bs. That's a challenged area that we're going to take a little peek at down the line here in several moments. But everything else is up, but not very much. Treasuries, I'm not sure what happened here. Okay, Treasuries up 1.2 only. RMBS only up 1.6. So another challenge, this is one of the reasons why RMBS has had a tough headwind. we not only do we have agency mortgage securities outstanding, but we had the Fed ownership and the banks selling with problems at the regional banks. So we say that the total outstanding goes up, but the buyers are, well, two of the buyers are gone. Two of the buyers were sellers over the past couple of years or 18 months, both the commercial banks and the Federal Reserve Bank. So mortgage spreads had to widen out, which means prices appreciating less than treasuries on a duration neutral basis. And now they remain attractive because of the lack of risk with the average price at 87 and with the yield spread, as we'll see later, being quite high on historical terms, particularly once you adjust for risk. So one thing about mortgage spreads, they also track volatility. We've got a volatility index on here. That's the blue line. And then we see the mortgage spread versus the 5-year treasury, which is at 154 basis points, which is pretty high. Your eye can see that. This goes back, 18 years. And volatility in bonds will be coming down. It's already starting to come down. You can see the blue line is relaxing. I expect that's going to come down in 2024. And that should be we should go from headwinds to tailwinds for these types of assets, both treasuries, which are already doing very well for the past 6 weeks or so, and then mortgages, which are also performing. You can see the spread has been narrowing with the lower volatility. We think that's going to continue. So I talked about how mortgage rates are really high versus what people are paying if they took a mortgage out three or more years ago. This is just a proof statement. We see here's the effective interest rate on all mortgage securities outstanding is 3.74, but the mortgage rate as of November 30th, a little lower now, but it was at 7.07. So this is the lock-in effect, where you'll notice going back to 1998, it's never been this type of a gap ever. In fact, it's never been materially higher or lower than the existing supply because rates were so stable. This is another variable that has changed with the turnaround to higher interest rates. Here we have Morgan Stanley calculates current coupon mortgage OAS, and we can see how overvalued mortgages were back in 2021. We went to our lowest percentage ever in that time period in the agency mortgage market for DBLTX and other portfolio strategies, and we see how much they cheapened. I mean, the OAS went from negative 40 to positive 60 or even 70, and now it's fallen down to about half of where its apogee was. But I would expect that this should come down. We have the 5-year average on here. That's a reasonable expectation. So that could very well be a tailwind. We also don't just own pass-throughs. Andrew will go through this. We own CMOs, structured product, in lieu of agency mortgages. They're agency guaranteed. And one of the reasons is this chart. You'll notice that for much of the pre-2023 period, going back to 2021, there was very similar convexity from the CMO market versus the pass-through market, but there's a huge gap now. Convexity is a good thing. Positive convexity is a good thing. It means you have more upside than downside for a symmetric interest rate move. And so CMOs are a very attractive place to be, and we've been increasing our holdings there sort of systematically over the past several months. I'm going to touch briefly on commercial real estate. And then I'm going to turn it over to Andrew to go through DBLTX more granularly. And then I'm going to return to answer about 5 or 6 questions that I've already selected from the queue. So this is delinquencies on CMBS. And there's one thing you have to realize about commercial mortgage-backed securities is it's not really a sector. It's a sector of sectors. There's multifamily, office, retail, industrial, lodging, and then sort of a catch-all of other. But the point here is that they behave very differently during different economic cycles. So right now, what's really challenged, of course, is office. And that orange line, you'll see, has risen quite a lot. Typically, office had very low delinquencies. They were down at around 2%. Now they've risen up to be kind of average for CMBS sectors broadly. But this is a high level for office. And we're starting to see continued stress in like CCC office-related commercial mortgage-backed securities. We have a very large, very experienced CMBS team. They've been navigating through this cycle extremely well, And so we do not have an index fund approach whatsoever. But you'll notice that most sectors are still pretty calm. Industrial doesn't really have delinquencies. We see multifamily, thanks to the shortage of that will be filled with new multifamily coming on stream that we talked about earlier. Those are low. And then we see the other is sort of kind of moving along. And we see the others categories like lodging has completely reversed from a horrific delinquency back in 2020. And we also see that retail has, it's come down, but it seems to have stopped coming down. So these are different sectors that behave differently, and we manage these allocations actively. I wanted to focus in, one of my slides vanished, so I won't bring it up. But this is the spreads on CMBS by letter rating. And you'll notice that the CCC has not improved. It blew out in 2022, and then blew out again in later 2022, and then blew out again in the first, really with that regional bank problem, and has not recovered in any meaningful way. So the spread is 914 basis points. Obviously, one should expect defaults on a BBB security that has 914 basis point spread to treasuries. It's clearly pricing in a non-par payback. You'll notice that the single A's, the double A's, and the triple A's are all pretty benign in terms of their spread. They blew out with the CCC sector and the regional banking problem, but we have pretty much normalized on the single A's. It's still a pretty big spread. You might get a default here or there. The double A's really, if you're underwriting it the right way, you won't get defaults on double A's. So here is a real opportunity to own something that even today yields almost 7%, and you can easily manage it without default risk. Oh, here's the slide. I had them in the wrong order in my deck. So I want to zoom in on the commercial real estate delinquencies. And this is on non-owner occupied properties. And this is that office sort of thing again. And you'll notice that it's still getting worse. Delinquencies continue to go up. I think there are many companies that I know in Southern California here that are shrinking their office footprint, and there's nobody to soak it up. So this trend sure looks like it's well in place. And then here's the pipeline of maturing CRE securities, commercial real estate securities, and there's a lot of them coming in 2024. But you'll notice on the right-hand display that 2024, most of these loans are owned, 50% of them, by banks, depositories. You notice that the dark area is CMBS. It's securitized. It's in the market. So if a small amount of the maturities affect the outstanding CMBS market, and even smaller number in 2025. It's interesting that as the maturity wall on the left-hand side of the display shrinks markedly from 2024 to 2028, you'll notice that the maturities of the CMBS market are almost identical. So they don't really have this sort of maturity wall problem. It's the banks that are facing this problem. With that, I'm going to turn it over to Andrew. Andrew, please go ahead.
Anyhow, all this discussion about recessions and such, investors are really keenly focused on the consumer these days. And the reaction function we can see here was essentially instantaneous on the consumer side once the last stimulus checks were sent out. Credit fundamentals, they've weakened. But at current levels, if you look at these trajectories, it may be more fair to call this normalization than really kind of entering into a crisis type situation. Credit availability, employment levels, other economic factors will dictate where it goes from here, but we are watching that pretty closely. Well, on this page, if we just look at the two charts on the left, we're showing credit card delinquencies by card issuers. And across all cohorts, the trend is showing higher prevalence for missed payments. We can also see the dichotomy between higher and lower quality borrowers. The blue line at the bottom of the page represents American Express. Typically, their customers are going to have the highest credit scores. And here we see that there's relatively low level of delinquencies. At the other end of the spectrum, the yellow line, this represents a entity called Bread Financial. They are a fintech lender in this space. Their client base tends to be lower credit quality borrowers, and thus you do see higher levels of absolute delinquencies. Very similar story on the right-hand side, but instead we're looking at defaults, and you do see upward trending defaults across all issuers. Now, the two takeaways from these charts would be, first, regardless of credit quality, across most cohorts, delinquencies have retraced back to pre-pandemic levels. So no longer are we enjoying artificially low delinquencies. Secondly, higher defaults aren't enough to flush out the troubled borrower. So we continue to see rising delinquencies, even despite rising losses. We are tracking this closely. If these trends do persist, we may move out of this whole normalization phase into more of a fundamental where consumer stress starts taking a bigger toll on the overall economy. When we look at the broader market, it does become apparent how consumers are triaging their liabilities. Again, credit cards will be purple line in this case, showing pronounced rebound in delinquencies. But then at the opposite end of the spectrum, mortgages showing continued strength. Housing market remains very strong. It's incentivizing borrowers to continue making their payments. And this can be seen with just only a slight uptick in the red line here. Student loans, we've talked about it at length in the past. It never seems like anything's going on in the student loan market. Finally, since August, payment moratoriums have ended. Payments need to be resumed. And what's really interesting is that we saw a rash of payments come into this market. Part of it is catch-up payments. The other part is borrowers looking into refinancing into other programs, such as the income-based repayment program. So that has led to an increase in prepayments rather than an increase in defaults. We do think this is short-lived, and we will see delinquencies start showing up in that sector. Big disparity here between charge-off rates for private label credit cards, and this is the yellow line, and this is versus the largest credit card issuers, both in the United States and Canada, and these are represented by the dark and light blue lines. Generally, private label cards typically will have a lower credit quality borrower, and this is going to be consistent with our earlier message that this cohort is disproportionately negatively impacted during times of financial stress. You can see this with the rapid ascent in charge-offs with the yellow line, while at the same time, the blue line is barely showing any type of increases in charge-offs. Finally, the teal line here represents the payment rate within the largest credit card issuer. So representing the borrowers of the light and the dark blue lines. And what this is showing essentially is a 40% payoff rate, meaning they're paying off 40% of their balances in a month. That's very, very significant. And it is reasonable to say at this time that the higher credit quality borrowers, they continue to have ample liquidity as evidenced by this payoff rate. Looking at recovery rates, we can see them falling across the board, almost regardless of the quality of the borrower. When you couple this with what we're seeing in delinquencies and defaults, this does reinforce our view that the consumer is walking a pretty fine line here, and further deterioration will have a meaningful impact on the economy. Similar to the CMBS slide Jeffrey showed earlier in terms of spread, we have seen weakening fundamentals within the consumer, but demand for investments in consumer-oriented sectors has been robust. And here we're looking at the credit curve within certain consumer sectors. And what that is for this chart, or what this chart is doing, is essentially taking the difference between one rating category versus another. So if spread level is high, it's going to indicate that the investor is getting significantly more spread or compensation as you migrate down in rating. So if we first look at the black line, this represents autos. Plenty of news about autos, but despite that, we have seen spread compression across the credit curve. So you see that black line kind of tapering downwards, as long as we're comparing the investment grade segment. So the black line is looking at triple B spreads minus AAA, and that is compressing. Where we haven't seen compression is in the below investment grade segment of the market. And you can see that with the gray line, it does remain elevated, and investors, they continue to be concerned about fundamentals, and thus are demanding a higher risk premium to be involved in riskier tranches of the market. We'll cover this in just a few slides, but Jeffrey already alluded to it. DBLTX is focused on senior tranches at this time, and we are seeing very attractive yields here, and don't feel the need to necessarily expose our investors to increased levels of risk. Looking about details about the fund, And building on ideas from the last slide, this is a visual depiction of the Treasury curve, which is the blue line going across the page. And each of the red diamonds is showing an actual component of the total return bond fund. All of this data is as of October 31st. We do tend to think of the architecture of the fund as a barbell. On one side, we have credit risk. And then on the other side is where we're expressing our interest rate views. On this chart here, everything to the left of the 5-year point of the curve is our credit exposure. And these assets, they do have a dampened response to changes in interest rates, but they are positioned at the front end of a inverted Treasury curve. Again, this data is as of October. The curve is flattened throughout November, and more inverted through November. And here we're able to attain very attractive yields at that front end. In isolation, the yields, they're impressive. But if you factor in the high quality of the assets the investments are secured by, you'll really, truly appreciate the risk-adjusted return potential for some of these components. To the right of the 5-year part of the curve, we're looking for assets that have attractive yield, but also that positive convexity or positive optionality that Jeffrey spoke about. Government guaranteed mortgage market is uniquely positioned to offer that at this point in time, and we do see a lot of positive optionality now, and we are taking advantage of that. We know a lot of investors are content with their money market funds, but certainly worth spending some time and examining what's available on the bond market. Some of these opportunities are the best I've seen during my career. Again, looking a little bit more nuanced here, and now looking at CMBS, we did speak about the CMBS more broadly earlier. This slide depicts how the total return bond fund invests into the CRE or commercial real estate space. The pie chart on the left, it represents the entirety of assets in the fund, and it breaks out non-government guaranteed commercial real estate, and this is the dark gray and the light gray segments here. And this accounts for approximately 7% of the entire portfolio. Only 1.8% is exposed to office real estate, which is regarded as the higher risk subsegment of CMBS right now. On the right, we show investment types and the amount of protection afforded to these positions. You can see, regardless of instrument type, there's significantly more protection in the form of credit enhancement and LTV when you compare it to the serious delinquencies. Resiliency is important, but it shouldn't be the takeaway here. We are able to find great opportunities at discount dollar prices in this space, even when factoring in losses. We do see yields here in the high singles to low double-digit range. Moving on, portfolio statistics. We did mention positive convexity, and that's consistent with the discount dollar price of the assets. Duration, it's in line with that of the index. We're actually slightly shorter now into the end of November. And then the fund is seeing more than 150 basis points yield advantage versus that of the index. Fund is positioned at the longer end of this historical duration range. This is very much deliberate. And with the mortgage market offering these opportunities, we're able to maintain duration. The CMOs that were discussed earlier, utilizing those, and improve the overall convexity profile of the fund. 2 more slides for me before I hand this back to Jeffrey to answer the questions that have been coming in. Here we see fund composition. We have taken an overweight to government guaranteed assets. These would be the agency mortgage-backed securities, both pass-throughs and CMOs, agency CMBS and treasury positions. Credit accounts for only about 40% of the fund at this time. And I would reiterate, it is very high quality, but also high yielding credit at the same time. And then finally, focusing on just the credit portion of the portfolio, our average credit enhancement or the ability to absorb losses is represented by the blue line or blue bar, excuse me. And it remains robust and is providing a healthy amount of insulation against the serious delinquencies represented by the red bars here. Legacy, non-agency RMBS or mortgage-backed securities on the far left, you do need to factor in the discount dollar price that we're purchasing these at, and that would provide a very big boost to the blue bar on that subsegment. It's taken a lot of effort by the team, but we have positioned the credit portion of the portfolio so that it is resilient even in the most challenging economic environments. And despite the safety, it's also contributing handsomely to the amount of yield the fund can generate. So with that, I'm going to hand it back to Jeffrey. Thank you very much, and happy holidays, everyone.
All right. Thanks, Andrew. I'm going to go through about half a dozen questions here that cover the great majority of the many, many questions that get submitted. A few of them are by the same person. I thought they're very thoughtful questions, so I'm going to answer them. First, will the Federal Reserve wait to lower the Fed funds rate until the PCA is less than or equal to 2% per year? I think no. I don't think they're going to wait until the PCE is below 2%. I think that one of the things that's weighing on the Fed's mind, or should be, is this inverted yield curve and these higher interest rates are a big problem for the banking industry. Not just the regional banks that took it early and took it first, understandably, but what about large banks? There was a large bank a couple months ago reported that their investment portfolio was yielding 3. Well, the Fed funds rate is at 5 3/8. So if you're funding at 5 3/8, God forbid you have a spread above that, then you are losing money every second of every minute of every hour of every day. And weekends are really bad because you're losing money then too, even though you're not even, it's the weekend. So I think that that will be part of the problem, that the Fed is choking off profitability, not only at floating rate small companies that borrow in the bank loan market, which are obviously getting stressed as well, but the banking system itself. And I think that it'll be that stress that is a factor in the coming recession. And I think that the Fed will not be able to wait until the PCE is less than 2 or even equal to 2. So the next question is, what would the unemployment rate have to be for the Federal Reserve to lower rates before the PCE is 2%? And I'm going to say it looks a lot like their forecast, which was at 4.5. I think they lowered it a little bit at the most recent dot plot. But I think the unemployment rate, if it goes up to 4.5, I think that would pretty much seal the deal. And the Fed would have to raise interest rates, even if the PCE was, say, at 2 and 2.4 or something like that. Next question, if gasoline prices rise in 2024 and the PCE increases, will the Federal Reserve raise the Fed funds rate? Certainly they would. I think that if the PCE increases above where it is today, I think that's what the question is meant to be asking, that the year-over-year rate of the PCE goes up, I think the Fed would have to raise interest rates. It would be a really nightmare scenario if that happened. But of course, gasoline prices rising significantly in 2024 is kind of the definition of a nightmare scenario relative to the economic circumstance. Another question was asked by a few people. I'll paraphrase. Do you agree that similar to Japan, the Fed will eventually go to yield curve control to control interest rates and the deficit, as Congress does not control 70% of the mandatory spending? Somebody else asked the same sort of a question. How does a credit crisis in the United States play out if the Treasury market goes no bid? Well, what would happen is you would probably go into some form of yield curve control. That might work temporarily, but if the Treasury market goes no bid, it means rates are going up, and the whole house of cards falls down. We can't afford present interest rates, let alone higher interest rates, as this debt pile continues to build. You know, the debtclock.org website, we're now at 33.9 trillion. I felt like last time I looked, it was just crossing 33 trillion on national debt, but it's going to be 34 trillion before year end. So it says Japan's average interest cost is 0.9, the U.S. is 3. It kind of points out kind of the how much the BOJ owns, and we're only at we're close to that. We're only at 20%, so there'll be a lot of room to increase it. So yeah, we're kind of following Japan's model, although we have much higher interest rates, which makes it more difficult to manage that. And then somebody says, have high yield CCC interest rates peaked? I don't think so, and I wouldn't touch them. It says, does this investment carry have good risk reward? Well, it had good risk reward a year ago. And we saw that from the bloodless verdict of the market, looking at credit sector performance. CCC high yield did really well, up in the mid-teens type of a thing. So I do not think this is a good time, particularly recession-oriented. If these slides that suggest probability of recession is greater than it seems the Fed thinks, then CCC is not a good investment. And then finally, always to end on a little bit lighter of a note, do you agree that the Bills, the Buffalo Bills, are having one of the most entertaining and self-inflicted seasons of woe? And do you agree? And will they triumph to win the Super Bowl? I don't know about. I kind of feel like that guy Jim Mora. When they asked him, "Are you going to make the playoffs?" It's a very funny YouTube clip, and he starts going crazy, like playoffs. We got to win a game. Well, let's not worry about the Super Bowl. Let's worry about trying to make the playoffs. But I want to say one thing, which is about the Bills, and this is really unfortunate, I think, and that is it's getting to the point where you can't blame these last minute or two losses, going from being ahead to losing the game in the last 2 minutes. I think it's getting hard to blame it on just bad luck, because Sean McDermott, the head coach, has been to overtime in his career as Bills head coach 6 times, and he's lost all 6. And I think overtime in the NFL almost definitionally is a coin flip. You should win about half of them. So the odds of losing 6 in a row are pretty long. It's 64-1 against doing that. And if they go to overtime and lose one more game, well, it'll be less than 1% chance that could be attributed to the coin flip, or just pure bad luck. So I'm getting worried that we find more creative ways to lose in the last minute of a game. It's kind of as good as the congressmen are always able to somehow come up with some sort of sleight of hand on things and avoid dealing with the debt situation. The Bills somehow, once you get late in the game, all the Bills fans start to get a knot in their stomach. I mean, the last game against the Eagles, we actually went into overtime kneeling down with Josh Allen at quarterback. Should have been two timeouts, 20 seconds on the clock, and it should have been Bills winning in regulation. But instead, we, just like we did in that 13-second game where we lost the AFC Championship, we just find new creative ways. So it's getting tough. But I'm going to stay optimistic. I think the Bills' schedule is not as hard going forward as people think. But golly gee, here it is, week 14 already in the NFL. No time window goes faster than the blur of the NFL season, consistent with the parade of holidays where time just seems to speed up at a factor of like 3x. And that's what the football season's doing. So go Bills, and everybody, good luck for the remainder of 2023. Best wishes for the health and for the holidays and health in 2024. Thank you for your support of DoubleLine, and goodbye for now.